studying your last two. I swim med when turned in. The styrene down to mute. And can learn the pole that sunk he died.
In the previous section, we learned that the General Rate Income Pool, or GRIP, keeps track of income that has been taxed at the general corporate tax rate and may support eligible dividends. Now let's walk through a complete example to see how a corporation actually calculates its GRIP balance. Imagine a corporation called ABC Manufacturing Ltd. During the year, the corporation earns $900,000 of active business income before tax. Under the small business deduction rules, the first $500,000 of active business income qualifies for the lower small business corporate tax rate. This portion does not contribute to the corporation's GRIP balance because it has already benefited from the lower tax rate. The remaining $400,000 exceeds the small business deduction limit and is taxed at the higher general corporate tax rate. This is the portion that is relevant for GRIP. The corporation identifies this $400,000 of general rate income and records it as an addition to its general rate income pool. Now let's update the corporation's accounting records. Suppose ABC Manufacturing already had an opening GRIP balance of $50,000 carried forward from the previous year. During the current year, the corporation adds the new $400,000 of general rate income. The calculation is straightforward. Start with the opening GRIP balance of $50,000. Add the current year's general rate income contribution of $400,000. The corporation now has a closing GRIP balance of $450,000. This closing balance does not represent cash sitting in a bank account. Instead, it represents the amount of income that has been taxed at the higher general corporate tax rate and may support the payment of eligible dividends in the future. Think of the GRIP balance as a running tax record. Each year, the corporation examines its income, identifies the portion taxed at the general rate, and updates its GRIP balance accordingly. As long as additional general rate income is earned, the GRIP balance continues to grow. This is why accountants carefully review corporate income every year. Only the income that is taxed at the general corporate tax rate contributes to the general rate income pool. Income that qualifies for the small business deduction generally does not increase the GRIP balance. The key takeaway is simple. Calculating GRIP begins by identifying the corporation's general rate income. That amount is added to any existing GRIP balance, creating an updated balance that will be available to support future eligible dividends. Accurate tracking of this balance is an essential part of corporate tax reporting and dividend planning. In the previous slide, we learned how general rate corporate income increases a corporation's GRIP balance. Now let's see what happens when the corporation actually pays an eligible dividend. We'll continue with the example of ABC Manufacturing Ltd. After recording the current year's income, the corporation now has a GRIP balance of $450,000. This balance represents the amount of income that has been taxed at the general corporate tax rate and is available to support eligible dividends. Later in the year, the board of directors decides to distribute part of the corporation's profits to its shareholders. After reviewing the corporation's records, the directors declare an eligible dividend of $120,000. Once the dividend is paid, the shareholders receive the cash. But something else happens behind the scenes. The corporation must also update its GRIP records. Remember, GRIP is an accounting pool. Whenever an eligible dividend is designated and paid, the corporation uses part of its available GRIP balance. In effect, the corporation is transferring a portion of those tracked tax attributes to the shareholders along with the dividend. Let's perform the calculation. The corporation begins with an opening GRIP balance of $450,000. It then pays an eligible dividend of $120,000. That amount is subtracted from the available GRIP balance. The calculation is simple. $450,000 minus $120,000 leaves a remaining GRIP balance of $330,000. This remaining balance is carried forward and will be available to support future eligible dividends in later years. A helpful way to visualize this is as a bucket. Earlier, general rate income filled the GRIP bucket. Now, by paying an eligible dividend, the corporation removes part of that balance. The bucket is not empty, it simply contains less than before. Throughout this process, accountants carefully monitor the corporation's records. They verify the opening balance, add any new GRIP generated during the year, subtract eligible dividends that have been declared, and calculate the updated closing balance. This ensures the corporation always knows how much GRIP remains available. Notice that the cash paid to shareholders and the GRIP balance are related but not identical. Paying a dividend reduces the GRIP balance because the associated tax attributes have now been used. The corporation cannot continue to designate eligible dividends indefinitely without first generating additional GRIP through future general rate income. The key takeaway is simple. Every eligible dividend paid reduces the corporation's available GRIP balance. By updating the balance after each dividend, the corporation maintains accurate tax records and ensures that future dividend designations continue to comply with the Canadian corporate tax rules. We've now completed the GRIP calculation example. The final step is understanding why corporations and tax professionals spend so much time tracking this balance every year. Let's continue with our example of ABC Manufacturing Ltd. Think of GRIP as a balance that is constantly changing throughout the life of the corporation. It isn't calculated once and then forgotten. Instead, it follows an ongoing annual cycle. Each year begins with the corporation's opening GRIP balance, carried forward from the previous year. This represents the amount of general rate income that has accumulated but has not yet been used to support eligible dividends. As the corporation earns new profits during the year, it identifies the portion that is taxed at the general corporate tax rate. That amount is added to the existing GRIP balance, increasing the pool available for future eligible dividends. Later, if the corporation declares and pays an eligible dividend, the GRIP balance decreases by the amount of that dividend designation. Whatever balance remains becomes the opening GRIP balance for the following year, and the entire process begins again. This continuous cycle repeats year after year. Income increases the balance. Eligible dividends reduce the balance. The remaining amount carries forward into the next taxation year. Let's summarize the numbers from our example. The corporation began with an opening GRIP balance of $50,000. During the year, it earned $400,000 of income that was taxed at the general corporate tax rate, increasing its GRIP balance. The corporation then paid an eligible dividend of $120,000. After subtracting that dividend, the corporation finished the year with an ending GRIP balance of $330,000. That balance will now be carried forward and used in future years when additional eligible dividends are declared. This ongoing tracking is one of the responsibilities of the corporation's accountant or tax advisor. Before any dividend is declared, they review the opening GRIP balance, calculate any additions for the current year, subtract eligible dividends already paid, verify the closing balance, and update the corporation's tax records accordingly. Why is this so important? Accurate GRIP tracking ensures that the corporation designates eligible dividends correctly. It helps prevent reporting errors, supports accurate corporate tax records, and allows shareholders to receive the proper dividend tax treatment. Maintaining an accurate GRIP balance also supports Canada's tax integration system by matching corporate tax paid with the appropriate shareholder tax credits. The key takeaway is simple. GRIP is not a one-time calculation, it is a balance that must be tracked continuously throughout the life of the corporation. Every year, corporations add new general rate income, subtract eligible dividends, and carry the remaining balance forward. Careful tracking ensures proper dividend designations, accurate tax reporting, and compliance with Canada's corporate tax rules.